So you're scrolling through your phone right now, probably looking at that new car listing for the third time today. Maybe it's a sleek SUV with all the tech features. Maybe it's that truck you've been eyeing for months. And you're doing the math in your head. Okay, $850 a month, I can swing that. I mean, I'll have to cut back on some stuff, but I need a reliable car, right? And here's what happens next. You walk into that dealership, the salesperson is friendly, they get you approved, you sign the papers, and 6 months later, you're lying awake at 2 a.m. wondering how you're going to make next month's payment work. I've seen this exact scenario play out literally hundreds of times. And the worst part, it's completely preventable. My name is Rayhan, and I spend way too much time thinking about why people go broke buying cars they can't actually afford. If you're someone who's tired of living paycheck to paycheck while watching your friends somehow manage to have nice cars and savings, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, I'm going to walk you through exactly what you need to do before buying a car in 2026. Not the generic advice you'll find everywhere else. I'm talking about the actual framework that separates people who buy cars they can afford from people who end up financially underwater for the next 5 to 7 years. Here's the thing. The average new car payment in the United States right now is $743 a month. Used cars, $530 a month. And according to a 2024 study from Cox Automotive, the average auto loan term has stretched to 68 months. That's almost 6 years of payments. But here's what most people don't realize. That monthly payment, that's just the beginning. Let me show you what I mean. Let's say you buy a $40,000 car with a 7.5% interest rate over 72 months. Your payment is about $685 a month. Seems manageable, right? But over those 6 years, you're not paying $40,000 for that car. You're paying $49,320. That's almost $10,000 in interest alone. And we haven't even talked about insurance yet. The average full coverage insurance in 2025 was $2,150 per year, according to Bankrate. That's another $179 a month. Gas, if you drive 12,000 miles a year and a car that gets 25 miles per gallon and gas is averaging $3.50 per gallon, that's $140 a month. Maintenance, another $100 to $150 a month when you average it out. So that $685 car payment, the true cost is actually around $1,100 to $1,200 per month. And this is where people absolutely destroy their financial lives. Look, I get frustrated talking about this because I see it all the time. Someone making $55,000 a year, that's about $3,500 a month after taxes, spending $1,200 on a car. That's 34% of their take-home income on a depreciating asset. The recommended guideline? No more than 15 to 20% of your gross income on transportation. But here's the real kicker. According to a 2024 report from the Federal Reserve, 27% of Americans with auto loans are either behind on payments or struggling to make them. 27%, more than 1 in 4 people. Now, you might be thinking, okay, Rayhan, but I'm not stupid. I know cars are expensive. I've done my research. But here's what's actually happening in your brain when you walk into a dealership or scroll through those listings. Your brain is not making a financial decision. Your brain is making an emotional decision and then reverse engineering the logic to justify it. Let me explain this better. There's this concept in behavioral economics called mental accounting. Basically, we treat money differently depending on how we categorize it. When you see a monthly payment, your brain doesn't automatically calculate the total cost over time. It just thinks, can I make this payment work this month? It's like looking at a pizza and only seeing one slice instead of the whole pie. And dealerships know this. This is where it gets really interesting. Have you ever noticed how every car advertisement focuses on the monthly payment? $399 a month, zero down. They never say, pay us $28,776 over 6 years for a car that'll be worth $12,000 when you're done paying it off. Because that doesn't sound nearly as appealing, does it? There's also this psychological phenomenon called lifestyle inflation or lifestyle creep. You get a raise, you get a better job, and suddenly that $25,000 Honda Civic doesn't feel good enough anymore. You start thinking, I'm making more money now. I deserve a nicer car. And look, I'm not saying you don't deserve nice things, but here's the brutal truth. Most people upgrade their lifestyle before they've actually secured their financial foundation. They buy the car before they have the emergency fund. They increase their fixed expenses before they've eliminated their debt. They commit to years of payments before they've maxed out their retirement contributions. I had a friend, let's call him Mike, who got a promotion that came with $15,000 in raise. He was making $65,000, jumped to $80,000. First thing he did, traded in his perfectly functional 2018 sedan for a brand new $48,000 truck. His payment went from $350 to $820. 2 years later, he got laid off, and guess what was the first thing he couldn't afford? That truck payment. He ended up having to sell it for $35,000, but he still owed $42,000. He had to take out a personal loan just to cover the difference and get out under it. That $15,000 raise completely evaporated. Actually, worse than evaporated. It created a $7,000 hole he had to dig himself out of. All right, so let's talk about the actual math you need to do before buying a car. And I'm going to give you specific numbers because vague advice doesn't help anyone. First, the 20-4-10 rule. This is your baseline. You should put down at least 20% on a car, finance it for no more than 4 years, and keep your total transportation costs under 10% of your gross income. Let's break that down with a real example. Say you make $70,000 a year. That's $5,833 gross, or about $4,375 after taxes, depending on your state and deductions. According to the 20-4-10 rule, your total transportation costs should no more than $583 a month. Now, if you finance for 4 years with 20% down at a 7% interest rate, which is pretty realistic for 2026, and you want to keep your total costs under $583, work backwards with me here. Let's say insurance is $180, gas is $130, maintenance is $100. That's $410 already. You've got $173 left for your actual car payment. Over 48 months at 7% interest with 20% down, that $173 payment means you can afford about a $7,800 loan. With your 20% down payment, that's a total car price of around $9,750. Yeah, that's the math. On a $70,000 salary, following the conservative guidelines, you should be looking at used cars under $10,000. But Rayhan, I can hear you saying, that's insane. I can't find a reliable car under $10,000 in 2026. And you know what? You might be right, which is why we need to talk about what's actually possible versus what's ideal. Here's a more realistic framework. Most financial advisors will tell you that your car payment alone, not including insurance, gas, and maintenance, should be no more than 15% of your take-home pay. On that $70,000 salary, that's about $666 a month. If you finance for 60 months, which I don't love, but it's more realistic, at 7% with 20% down, that $666 payment means you can afford about a $35,000 loan, or about a $44,000 car total with your down payment. That's better. That's more realistic. But here's what I want you to notice. Even at 15% of take-home pay, you're still looking at a car that's 63% of your gross annual income. And remember, you still have insurance, gas, and maintenance on top of that payment. The average person, they're buying cars that cost 80 to 100% of their annual gross income, sometimes more, and they're putting little to nothing down, and they're financing for 72 or even 84 months. That's not a car purchase. That's a financial catastrophe waiting to happen. Now, let's talk about depreciation, because this is where people really get wrecked. Here's what most people don't realize. The moment you drive a new car off the lot, it loses about 20% of its value. Just like that. Gone. If you bought that car with no money down, you're immediately underwater on the loan. A study from Carfax and IC Cars in 2024 found that the average new car loses 49% of its value in the first 5 years, almost half. So that $45,000 car worth about $23,000 after 5 years. But here's the thing that makes this even worse. In the first year alone, most cars lose 20 to 30% of their value. But you know what doesn't decrease by 20 to 30% in the first year? Your loan balance. Let me show you what I mean with real numbers. Say you buy a $50,000 car with $3,000 down and finance $47,000 over 72 months at 7.5%. After 1 year, you've made 12 payments of about $805 each. You've paid $9,660, right? But how much of that went to the principal? Only about $5,570. The rest, about $4,090, was interest. So your loan balance after 1 year is $41,430. But that car, if it depreciated 25% in the first year, it's now worth $37,500. You owe $41,430 on a car worth $37,500. You're $3,930 underwater, and that gap actually gets worse for the next couple years before it starts to close. This is why people get trapped. Life happens. You lose your job. You need to move. You have an unexpected medical expense. And suddenly you need to sell that car. But you can't sell it for what you owe. You have to come up with thousands of dollars just to get out from under it. I saw this happen to a couple. Let's call them Sarah and Tom. They bought a $52,000 SUV right before they found out Sarah was pregnant with twins. Twins! Suddenly, they needed a bigger house. But when they tried to sell the SUV after 2 years to free up some cash, they owed $38,000 and it was only worth $31,000. They had to come up with $7,000 just to sell it. That's $7,000 that could have gone toward the new house or baby expenses or literally anything else. This is the hidden cost that nobody talks about. It's not just what you pay, it's what you lose the option to do with your money because it's all tied up in a depreciating asset. All right, so what do you actually do with all this information? Here's your step-by-step framework before buying a car in 2026. Step 1. Calculate your true car budget. Not the payment you think you can swing. Your actual budget is based on your financial reality. Take your monthly take-home pay, multiply by 0.15. That's your absolute maximum car payment. Then subtract $300 to $400 for insurance, gas, and maintenance. What's left? That's what you can actually afford for the payment. If that number is $200 or less, you're not financing a car, you're saving up and buying something with cash. I know that's not what you want to hear, but it's the truth. Step 2. Build your emergency fund first. Here's the thing. Life is going to happen while you're making those car payments. Your hours get cut, your transmission fails, your dog eats something stupid and needs surgery. If you don't have an emergency fund, guess what becomes your emergency fund? Credit cards at 24% interest. And now you've got a car payment and credit card debt. You've just made everything exponentially worse. Minimum emergency fund before buying a car, 3 months of expenses. Not 3 months of income, 3 months of expenses. If your monthly expenses are $3,000, you need $9,000 in the bank before you even think about walking into a dealership. Step 3. Save your 20% down payment. I know, that's a lot of money. 20% of a $30,000 car is $6,000. But here's why this matters. 1, you're immediately less underwater. You start with equity instead of negative equity. 2, your monthly payment is lower, which means you can actually afford it. 3, and this is huge, the act of saving $6,000 proves to yourself that you can handle the financial discipline of car ownership. If you can't save the down payment, you're not ready to own that car, period. Step 4, get pre-approved for a loan before you go shopping. This is where people get absolutely demolished. They fall in love with a car and then they let the dealership arrange the financing. And suddenly they're paying 12% interest because they have a 640 credit score and the dealer is making a nice commission on that interest rate markup. Go to your bank, go to a credit union, get pre-approved, know your rate, know your terms. Walk into the dealership with financing already arranged and tell them they can beat it or you're walking. Step 5. Calculate the total cost of ownership. Not just the price of the car, the total cost over the life of the loan. There's a great tool called the Edmunds True Cost to Own Calculator.
Plug in the specific car you're looking at. It'll show you depreciation, fuel costs, insurance, maintenance, repairs, and taxes over 5 years. A $35,000 Honda CRV might have a total cost of ownership around $50,000 over 5 years. That's $10,000 per year, or $833 per month just to own that car. Can you actually afford that? Step 6. Consider the opportunity cost. This is what people almost never think about. It's not just what you're spending on the car, it's what you're not doing with that money. Let's say you're deciding between a $25,000 used car and a $45,000 new car. That's a $20,000 difference. If you invested that $20,000 in the stock market at an average 8% annual return, after 30 years, that's about $201,000. You're not just spending an extra $20,000 on the nicer car, you're giving up $201,000 in retirement savings. That's the real cost. Or let's make it more immediate. That $400 difference in monthly payments, that's $4,800 per year. That could fully fund a Roth IRA. That could pay off high-interest credit card debt. That could be a vacation with your family every year. That could be your kids' college savings. Every dollar you spend on a car is a dollar you're choosing to not spend on something else. Make sure you're making that choice consciously, not just because the payment fits. Step 7. Run the what-if scenarios. What if you lose your job? Can you still make the payment for 6 months? What if interest rates go up and you need to refinance? What if the car needs a $2,000 repair? What if you need to move and sell the car early? If any of these scenarios would absolutely wreck your finances, you cannot afford that car. Full stop. Now, I'm going to challenge you even more. Maybe the answer isn't buying a car at all. What? Rihan, you've spent 16 minutes talking about buying a car, and now you're saying don't buy one? Hear me out. In 2026, we have more transportation options than ever before, depending on where you live. Car sharing programs like Zipcar or Turo, robust public transportation, e-bikes and electric scooters, ride-sharing services, working from home. I know a guy in Seattle who sold his car and uses a combination of public transit, e-bikes, and occasional Uber. He calculated he's saving about $750 per month compared to owning a car. That's $9,000 per year. After 5 years, that's $45,000 he put toward his house down payment instead. Now, I get it. This doesn't work for everyone. If you live in rural Texas, you need a car. If you have 3 kids and soccer practice every night, you need a car. But for a surprising number of people, car ownership is more about identity and status than actual necessity. And if you absolutely need a car, consider these alternatives to buying new. Certified pre-owned, CPO, you get a warranty, you get a car that's 2 to 3 years old and has already taken the biggest depreciation hit, and you pay 30 to 40% less than new. Lease takeover, someone else wants out of their lease, you take over the payments. Often you can get a great deal because they're desperate to get out of it. Buy a 5 to 7-year-old car with cash. This is actually my favorite option. Find a reliable brand, Honda, Toyota, Mazda, that's 5 to 7 years old with under 80,000 miles. Buy it with cash. Yes, you might have some repair costs, but you're not paying interest, you're not underwater, and you own it outright. I bought a 2016 Honda Accord in 2022 for $16,000 cash. It had 62,000 miles. I've put another 40,000 miles on it. I've spent maybe $2,000 in maintenance total, and I sleep great at night because I don't have a car payment. It's not income, it's not luck, it's this fundamental mindset shift. Wealthy people see cars as tools. Broke people see cars as statements. A car is supposed to get you from point A to point B safely and reliably. That's it. Everything else, the luxury features, the brand name, the status symbol, that's just marketing telling you that your worth as a human being is tied to what you drive. And look, I'm not saying drive a piece of junk. I'm not saying you can't have nice things. But what I am saying is this: the time to have a luxury car is when you've already built wealth, not when you're trying to look like you have wealth. There's this concept called stealth wealth. It's people who are actually wealthy but don't feel the need to show it off. They drive 10-year-old Camrys, they live in modest houses, they wear normal clothes, and they're millionaires. Because they understand something crucial. Every dollar you spend trying to look wealthy is a dollar you're not actually becoming wealthy. The guy driving the $80,000 BMW, he might be rich, or he might be making $75,000 a year and drowning in debt. You have no idea. The guy driving the $8,000 Honda, he might be broke, or he might have $500,000 in investments and just doesn't care what people think. Which one do you want to be? Before you even think about buying a car in 2026, I want you to do three things. One, calculate your real budget using the framework I gave you. Write it down, pin it to your wall. Two, start saving your emergency fund and down payment. Make it automatic. Set up a direct deposit from your paycheck into a separate savings account you don't touch. Three, go sit in your current car if you have one. Really look at it. Does it start? Does it drive? Is it safe? If the answer is yes to all three, you don't need a new car. You want one, and there's a massive difference. Look, I get it. I know the appeal of a new car. I know that feeling of driving off the lot with that new car smell, all the tech features, everything perfect. But you know what feels better? Financial security, having money in your savings account, not lying awake at night worried about payments, having options, having freedom. That's what this is really about, not cars, freedom. So do the math, make the smart choice. In the future, you will thank me. If this video helped you, smash that like button and subscribe for more honest financial advice. Drop a comment and let me know what car you're considering and whether you can actually afford it. I'll see you in the next one.